Welcome back to the PNJ Group series on the FASB Conceptual Framework. So far we have covered why reporting exists and what makes information useful. Now we get concrete. Before you can recognize, measure, or disclose anything, you have to know what kind of thing it is. SFAC 6 gives us 10 precisely defined elements, the building blocks every financial statement is assembled from. Master these definitions, and a surprising amount of accounting becomes a matter of careful classification. Let's meet the 10. By the end of this section, you will be able to identify all 10 elements defined in SFAC 6. You will define the three balance sheet elements, assets, liabilities, and equity, and apply the specific tests each definition requires. You will distinguish revenue from a gain, a distinction that has real consequences under the revenue standard. And you will explain comprehensive income and how it captures more than just net income. Let's start with the big picture of all 10. SFAC 6 defines 10 elements, and they split into two families. 3 describe financial position at a point in time, assets, liabilities, and equity. The other 7 describe performance and changes over a period, revenues, expenses, gains, losses, comprehensive income, investments by owners, and distributions to owners. Here's why this structure matters. Every transaction you ever record is ultimately a movement among these 10 categories. If you can correctly name what something is, the accounting follows. So precision in these definitions is not academic. It is where good accounting begins. An asset is a probable future economic benefit obtained or controlled by the entity as a result of a past transaction or event. 3 things must all be true. First, it embodies probable future economic benefit, some capacity to generate cash or reduce an outflow. Second, the entity can obtain that benefit and restrict others' access to it, which is about control, not necessarily legal ownership. Third, the event that created the right has already happened. That last point is easy to miss. A benefit you merely expect to acquire in the future is not yet your asset. A liability is the mirror image. It is a probable future sacrifice of economic benefits arising from a present obligation to transfer assets or provide services. Again, 3 requirements. A present obligation must exist now. A future sacrifice must be probable. And the obligation must arise from a past event, not from something you merely plan to do. This is where things get interesting. A company can fully intend to buy equipment next year, but intention is not obligation. Until a past transaction binds you, there is no liability, no matter how certain your future plans feel. Equity is the simplest definition and the most quietly important. It is the residual interest in the assets after deducting liabilities. Assets minus liabilities equals equity. There is no separate test for equity. It is simply whatever is left for the owners once every obligation is accounted for. Equity changes through 3 channels: investments by owners, distributions to owners, and comprehensive income. That residual nature is why equity absorbs the effect of every measurement choice on the other side. Get assets or liabilities wrong, and equity is automatically wrong too. Here's a trap worth flagging. The word probable in the asset and liability definitions is a lower bar than the probable used in contingency accounting under the loss standard. A receivable with some collection doubt is still an asset. The uncertainty does not strip it of its element status. It simply affects how you measure it, through an allowance. Most people blur these 2 meanings and get into trouble. Remember the principle. Uncertainty usually changes the measurement, the number, not the classification, the category. Keep those 2 questions separate, and you will avoid a common error. Now the performance side. Revenues are inflows from delivering goods or services in the entity's ongoing major or central operations, and expenses are the outflows from those same central activities. Gains and losses come from peripheral or incidental transactions instead. Sitting above them all is comprehensive income, the total change in equity during a period from everything except transactions with owners. That means it captures net income plus other comprehensive income. The items parked in OCI comprehensive income is the widest performance lens, showing changes that net income alone would miss. This distinction sounds academic, but it is one of the most practical calls you will make. Whether an inflow is revenue or a gain depends on one question. Is the activity central or peripheral to operations? A car dealer selling a car earns revenue, that is the business. A manufacturer selling off surplus equipment at a profit records a gain, because selling equipment is not its business. Why care? Because under the revenue standard, a SC 606, this distinction can affect presentation and even the timing and allocation of the transaction price. When in doubt, escalate to your team lead. Let's bring it home. SFAC 6 gives us 10 elements, 3 for financial position and 7 for performance. Assets and liabilities each require a present right or obligation arising from a past event, not a future plan. Equity is purely residual, assets minus liabilities, so errors elsewhere land there. And the revenue versus gain question always turns on whether the activity is central or peripheral, with real consequences under a SC 606. Next, we look at how an item earns its way onto the statements through recognition. Thank you for completing this section on the elements of financial statements.